Right now, the S&P 500 is sitting near all-time highs.
The headlines say the economy is strong, unemployment is stable, AI is changing everything. But here's what they're not telling you.
The Shiller PE ratio, the most reliable long-term valuation measure in market history, just hit 36.4. The last time it was this high, 1999, right before the dot-com crash wiped out $6.2 trillion in wealth.
The Buffett Indicator, total U.S. market cap versus GDP, just crossed 237%. Warren Buffett himself called anything above 200% playing with fire.
And the U.S. government is now spending $1 trillion a year just on interest payments.
Welcome to Capital Drift. I'm going to show you exactly where the next bubble is forming, why most people won't see it coming, and what smart money is quietly doing right now to prepare. Stay with me. Let's start with the most dangerous phrase in investing.
This time is different.
People said it in 1999, when tech stocks had zero earnings, but sky-high valuations. People said it in 2006, when housing prices supposedly never go down.
And right now, people are saying AI is so transformative, the old valuation rules just don't apply anymore.
Here's the truth. Bubbles don't pop because of bad news. They pop because expectations get too far ahead of reality.
And in the United States right now, we have not one, but 3 separate pressure points building at the same time. First, the AI and equity bubble. The 5 largest companies now control 30% of the entire S&P 500. That is the greatest concentration of market power in over half a century.
The top tech names alone accounted for 53% of the index's total return last year, according to Goldman Sachs. Think about that. If you own an index fund, more than half your gains in 2025 came from a handful of AI stocks. And right now, only 4% of S&P 500 stocks are actually at historical highs, while the index sits near record territory.
That is almost exactly what it looked like at the dot-com peak in 2000.
Second, the sovereign debt bubble. The national debt just crossed $39.28 trillion. That's roughly $115,000 for every living American. The deficit this year is projected at $1.9 trillion, nearly double the 50-year historical average as a share of GDP. And interest payments alone just hit $1 trillion this year, more than the entire U.S. defense budget. Third, the false calm. The VIX, Wall Street's fear gauge, was near multi-year lows just months ago. Credit spreads are tight. Volatility is compressed. Markets are pricing in a world where everything works out perfectly. But history is clear. The longer the calm, the more violent the storm. So where does the trigger actually come from? Let me show you the evidence trail. The AI trade is pricing in a revolution that hasn't happened yet. Look, NVIDIA is real. The company posted $215.9 billion in revenue last fiscal year, with 71% gross margins. These are not dot-com era companies with zero earnings. The cash flows are genuine. But here's the problem. As of May 2026, only 19.8% of U.S. enterprises have actually deployed AI in any meaningful way. Bank of America research puts the peak annual productivity boost from AI at just 0.1 to 0.6 percentage points. And that impact plays out over more than a decade. The market is pricing in a 10-year revolution as if it's arriving in 18 months. That gap between expectation and reality is exactly where bubbles live. And the spending numbers make it worse. The largest tech companies burned through $400 billion in capital expenditures in 2025, nearly 70% more than the year before, per Goldman Sachs.
That CapEx is now approaching 75% of their cash flows, a level that historically forced companies to start funding growth with debt.
Sound familiar? That is almost precisely what happened in the late 1990s.
And here's the stat that should make you stop scrolling. 54% of professional fund managers, more than half of the people who do this for a living, now call AI stocks a bubble. Yet prices keep climbing. Why? Because no one wants to be the one who misses the party. That is the psychology of every bubble that has ever existed. The debt fuse is already lit. This is the part most financial channels skip because it's slow, it's boring, and then it's suddenly catastrophic. The Congressional Budget Office, the nonpartisan financial scorekeeper of the U.S. government, projects that net interest payments will total $16.2 trillion over the next decade, rising from $1 trillion this year to $2.1 trillion by 2036. The GAO, the Government Accountability Office, confirmed in June of this year that interest costs on our debt now exceed the entire defense budget. Federal debt held by the public is at 101% of GDP right now. The previous all-time record was 106%, set right after World War II. We are closing in on that fast. Here's how this hits you directly. When the government has to borrow $2 trillion every single year, it competes with every other borrower for capital. That keeps interest rates higher across the entire economy. Higher rates mean higher mortgages, higher car payments, higher credit card debt, and lower valuations for every growth stock in your portfolio. Deutsche Bank calls this fiscal dominance, a regime where the Fed cannot raise rates aggressively to fight inflation because doing so would risk triggering a fiscal crisis. That is a trap. And we may already be in it. What the bond market is actually telling us. Here's something the smart money knows that most retail investors don't. The bond market always knows before the stock market. And right now, bonds are flashing yellow. The 30-year Treasury is yielding 4.87%. The 10-year sits at 4.37%. One analyst at Standard Bank has predicted the 10-year breaks 5% before year-end. Every time long-term yields rise sharply, it creates what's called valuation compression. Future earnings become worth less today, and high-multiple, high-growth stocks, the AI darlings you have in your index fund, take the biggest hit. The current Shiller PE of 36.4 sits at the 98th percentile of its entire historical range. It has only been higher for 2% of all recorded market history. The one time it was meaningfully higher? December 1999. And we already have a preview of how fast this can move. In January 2025, a Chinese AI startup called DeepSeek released a model that matched the best American AI and reportedly trained it for just $5.6 million. One headline, one morning. NVIDIA lost $588.8 billion in market value in a single day. The largest single-day loss for any company in the history of financial markets. That was one AI headline. Imagine a synchronized earnings miss from multiple AI giants at the same time. Now, I want to be clear. This is not a panic video. Bubbles can run longer than anyone expects. Smart investors didn't short the dot-com market in 1997. They quietly repositioned. That is the move right now. Here are 4 things you can do before this becomes front-page news. Move 1. Break the concentration in your index fund. If you're holding a standard S&P 500 fund, VOO, SPY, IVV, you are heavily exposed to just 5 companies. Consider adding an equal weight S&P 500 ETF, like ticker RSP, alongside your existing holdings. Equal weight funds spread your risk across all 500 names instead of stacking up on the biggest. One simple shift. Dramatically different risk profile.
Long-duration bonds get crushed when yields rise. And right now, fiscal pressure is pushing long-term yields higher. Both Charles Schwab and RBC Wealth Management currently recommend short to intermediate bonds, maturities in the 2 to 7 year range. Investment-grade corporate bonds in that window give you real yield without the rate risk of a 20 or 30-year treasury.
Warren Buffett's Berkshire Hathaway was sitting on a record cash pile heading into 2026. That was not a mistake. That was strategy. Consider keeping 10 to 20% of your investable assets in a high-yield money market fund, currently earning 4.5 to 5%. You are getting paid to wait for better entry prices. That is not sitting on the sidelines. That is being ready. Gold is up over 67% in the past year alone, confirmed by Treasury Department data. International developed equities, particularly Europe and Japan, are trading at a meaningful discount to U.S. valuations. Real assets, commodities, these are the positions institutional investors are quietly building right now as a hedge against equity volatility and dollar weakness. You do not need to abandon U.S. stocks. You just need to stop betting everything on one outcome.
Here's the bottom line. The bubble isn't a single asset. It is system-wide overconfidence in AI earnings, in U.S. fiscal sustainability, in the idea that volatility is somehow gone forever. Smart money is not panicking. It's positioning. The question is never whether the next correction is coming. The question is whether you will be ready when it does.
If this video changed how you're thinking about the market, hit subscribe. Every week on Capital Drift, we follow the data that nobody else wants to touch. And drop a comment below. I want to know, which of these 3 bubbles worries you most? AI stocks, the national debt, or the treasury market? I read every single one. See you in the next investigation.